Welcome to the American Capitalist Show. If you've got a family, if you have a business, buying life insurance is probably going to be the single most important decision that you're going to have to make. And unfortunately, there's a lot of ambiguity. People don't know what type of life insurance, how much they need. And because there's this ambiguity and because there's a lot of money for people selling you the incorrect life insurance out there, you're going to get hit up time and time again to buy an insurance policy that's not going to help you, but it's going to help those agents line their pockets. And today what I want to do is make sure that doesn't happen to you. I want to make sure that you're not a family that I'm thinking of right now that I knew. It was a young couple, father, mother. They had two little children, I believe 3 and 2 years of age. They were sold the wrong type of life insurance policy that the agent made a lot of money on. But when the father died, who was the only breadwinner in the house, the mom was left with a $100,000 life insurance policy, which, if you know, provides about $5,000 a year in income, not nearly enough to take care of them. They lost their house. The mother had to go back to work, and it completely destroyed the family. So I want to make sure today that doesn't happen to you. It doesn't happen to anyone you love. You don't put yourself in a position where if you or somebody else that's a key member of your business dies, that you're going to have to close shop on your business. And I'm going to give you every single thing that you need to know today to protect your family and make sure that you don't put yourself into a position where you become a victim of one of these insurance agents who only have their own best interests in mind. Okay, let's start by breaking down the anatomy of life insurance. What is it? Why are you even using life insurance? What are the different types of life insurance? First of all, insurance as a concept, what are we trying to do with insurance? Because what we're not trying to do with insurance is invest. It's not an investment. Stocks are an investment. Real estate's an investment. Cryptocurrency is an investment. Insurance is not an investment. Let me repeat that. Insurance is not an investment because one of the doors that gets opened to making people invest in insurance and make the wrong decision is by believing that insurance is an investment. It's not. It's a risk mitigation tool that allows you the opportunity to make investments. And when you insure something, what you're looking to do is take the risk from yourself, from your family, from your business, and you're looking to transfer that to another party. That's what you're looking to do, and in this case, an insurance company. Now, what do you insure? What don't you insure? Well, one of the biggest scams out there is, have you ever gone to a Best Buy or somewhere where you buy some headphones or one of these electronic products and they try to get you to buy an insurance product on that? They make millions and millions of dollars off of that. These policies are never used. You wind up spending money on something that you don't need. And at the end of the day, if your $99 headphones broke, hopefully you'd be able to have the money to what we call self-insure that. However, the corollary is if you've got a $500,000 home and that home burnt to the ground, you're more than likely not going to have the savings to be able to take care of that and make yourself whole, which is why you buy fire insurance on the house. So that is a concept before we get into the different types that you have to understand. What you're looking to do is take any type of risk when you insure anything and transfer that risk to someone else because you financially would not be able to take care of that. You financially could be ruined if that expense comes to you. And that's why actually wealthy people wind up self-insuring a lot of things because they have the money to do that themselves. But if you're the average person, you need to insure things. So when you start thinking about life insurance, what you're looking to do is take the risk to where if you were to pass away, how do you provide the money that is needed either to your family or if you're looking to insure your business to make sure that they can go and hire another person to replace you, or to make sure, most importantly, your family has the income that they need to carry on their lifestyle, pay the mortgage, put the kids through school, whatever it is. When you pass away, is there a dollar amount that will allow them to sustain their lifestyle without anything changing? And I think that's what we're all trying to do, myself included, with life insurance, is make sure that if we pass away, our families are taken care of. And the way that you can do that, I'm going to show you today. We're going to talk first about the different types of life insurance. Yes, there's tons of different types of life insurance, and everyone's going to give you different spins on them, but there's really two categories that you need to be aware of in life insurance. And they come down to two things. One is a temporary type of life insurance, which is called term life insurance. And that term of that policy, it's called term because the insurance coverage lasts for a certain period of time. Typically, the shortest period would be a 10-year term. One of the most popular is a 20-year term. And we also, and I own, a 30-year term policy. So what it's basically saying is for 10, 20, or 30 years, if you pay the premium, and you would pay for that premium monthly or annually, however you want to pay it, for either 10 years, 20 years, or 30 years, as long as you do that consistently, it is going to be tied to a death benefit, a lump sum dollar amount that will then pass to your beneficiary, whether that's a business or your spouse or your children. That's what you're going to be doing with that. Now, the thing to understand is with term life insurance is the cheapest type of life insurance that you can buy. So you're going to get your most bang for your buck. If you're looking to get, let's say, $1 million or $2 million policy, there's no other type of insurance that's going to be cheaper for you to be able to obtain that than a term life insurance policy. The other type of life insurance policy, and this is probably the single most confusing thing out there, not only for the people who are buying the policy, but most agents who are selling this have no idea how it works either, unfortunately, to be honest with you. And we're going to call these cash value or permanent life insurance policies. And within cash value or permanent life insurance policies, you have whole life insurance, you have index universal life insurance policies, you have variable universal life policies. So there's tons of them, but they really kind of all work the same way. The idea is you pay into these typically for life or a period of time that they set up, and a portion of that money goes to the insurance part of the policy, and then the other part of that money goes into a separate account. Now, that separate account is the differentiator. So let's just say, for example, you pay $2,000 a month. Well, $1,000 of that might go towards the insurance coverage itself. The other $1,000 goes into a separate account. And that's really the differentiator in these policies is what's happening in that separate account. Well, whole life would be typically some type of fixed rate that's based off of the claims paying ability of the carrier. So they might set a rate 3-4%. A variable universal life policy would go into some quasi-mutual funds that it would be invested in. A index universal life policy, which is probably one of the most sold, or I would say oversold policies that are out there, goes into an account that's supposed to give you market type returns. Now, an index universal life policy, actually, it's a policy that's been in the news lately. If you've heard of Kyle Busch, he's a NASCAR driver. Him and his wife, they just filed an $8.5 million lawsuit against Pacific Life because they said they were sold one of these policies, lost that amount of money from an agent who had a background of complaints, misleading people, and they were sold something that they didn't understand and lost $8.5 million. So it's not just the average person, it's people with means like Kyle Busch and his wife that are also losing money to these policies. Again, let's think about what I said prior to this. What are we trying to do when we insure something? What we're trying to do is get a lump sum death benefit that pays our business, or let's most importantly talk about our family, to give them the money that they need if I can't work anymore. So if I'm a father and I've got a mom who stays home with 2 young kids, and let's just say I make $100,000 a year, my wife doesn't work. If I die, the bills don't go away. Kids still need to eat. You still need to be able to pay the mortgage or the rent. All those things still need to happen. So what I'm trying to do when I buy a life insurance policy is buy a death benefit to where my wife will get a check, and that check provides her the income to replace my income that's no longer going to be there. That's essentially what we're trying to do. And again, I told you term is always going to be the cheapest way to do that. I also told you that insurance is not an investment. So if you think back to what I was just saying about these permanent cash value life insurance policies, why would you spend more money to put something that's a quasi-investment, bad investment, just to be able to solve for what we're trying to do is give our family a death benefit, a dollar amount that they can take care of themselves with. The great thing also about life insurance, why it's the single most important tool. When I do financial plans for people, I was a financial advisor for 25 years. The first thing I make sure people do is have an emergency fund, right? If you get disabled, if something happens, an emergency comes up, you want to have anywhere from 90 days to a year's worth of expenses put away. That's the first thing I have everybody do. But the second thing I have every single person do that's got children or has liabilities, has people depending on them, is I have them buy a term life insurance policy. Why? Just this couple I told you. How could I tell somebody to invest in a mutual fund or a stock or real estate or do anything to where if they were not going to be around in a year from now and their income wasn't there, that their family would be left in the streets? I obviously couldn't do it. And that's how important life insurance is. And that's why I told you this topic is going to be so important and why we're talking about the two types of life insurance and which one should you be using. A lot of people ask me, Rob, why doesn't everybody just use term life insurance? And okay, I've been pitched these index universal life policies or whole life policies, and the agents tell me a lot of things. Well, one of the first things they say always, and I hear this all the time, guys, when you buy a term life insurance policy, you're just throwing your money away for 10 years, 20 years, 30 years. You're just flushing it down the drain because at the end of that term, you've got nothing left. And that's the hook that they use to get you. When you think about that rationally, yeah, it's true, Rob. If I pay that, you already told me at the end of 10, 20, 30 years, I paid into this thing, but I've got nothing left. Here comes the insurance salesman to the rescue to say, hey, yeah, with this, you pay a little bit more, but at the end, you have this investment. And they always try to tell you that it's tax-free. And they use the stock market to scare you because we all know the stock market goes up and down. Fear sells, and they try to tell you, hey, do you want to invest in the stock market and lose all your money? Even though we all know, guys, if you listen to me, the stock market always goes up over time. Every single time the market crashed, 1987, 2000, 2008, COVID, every single one of those times the market came back. But when you're scared and the market's going down and someone's coming out to you and trying to convince you that you don't want to be invested in the stock market, these types of index universal policies sound really appealing. What they sell you, and this is the pitch you'll hear, is that you get market-like returns with no downside risk whatsoever. And so what I want to do is kind of show you how do these things play out. And this is the exact way that I've used life insurance for pretty much every single one of my clients for over 25 years. It's the same way I have approached life insurance for myself. And I'm going to show you exactly how we would do that. So let's take a sample couple, Mr. and Mrs. Jones. They're both 30 years of age. They've got two children, let's call it ages 2 and 3. They have a home with a $500,000 mortgage. That mortgage payment is $2,500 a month. And all of their other expenses, food, shopping, all those things total $5,500 a month. So if you take all their total expenses, they've got $8,000 in monthly expenses. So whatever it is that you have, you could do those same things. If you don't have a mortgage, it's your rent. But what you want to do is total up what are your total monthly expenses. And in this case, I'm also going to solve for their liabilities. And their liability is this mortgage, which is $500,000. Okay. So what am I going to solve for? If you came to me today and you were this couple, what am I looking at life insurance to do? Well, I'm looking for it to do two things. Number one, if the husband passes away, and let's just say he's the only one who's making any money right now. Let's just say he's making $100,000 a year, and we want to be able to replace his income. Well, the first thing I'm going to do is take care of that liability. Their biggest liability, one of their biggest expenses is the mortgage. We know that's $500,000. So I know now I at least need $500,000. Okay. What I'm left with, if I do that, is I still have to solve for the other $5,500 in other expenses. And so what you're trying to do now is solve for a lump sum. Remember, because life insurance is a tax-free lump sum benefit, which means they give you a check. So far we've collected a check for $500,000, tax-free. We send that out to Chase, Bank of America, whoever it is. My wife now has the house paid off, so there's no more mortgage payment, but she's left with these $5,500 in bills. So now I need to figure out what is the lump sum that's going to take care of that. And so for the rest of the bills, it's $1.5 million. And where do I get that from? It's $6,250 a month that's going to provide. So if I take that lump sum, I take 5% of that, that'll give me $6,250 a month. I told you that their bills were $5,500, but you have to pay a little bit of taxes on that. So if I take that 1.5 million, it gives them that income that they need every month. Plus, we've already paid off the mortgage. So now what I've done is I've taken 500,000 plus 1.5. I add those two things together. I know for this family that I'm going to need a $2 million death benefit. And my goal as their financial advisor is to do that as cheaply as possible. So in reality, what we're going to do is basically take the husband, his health, all those things, and we send it out, and this is what you should do, and shop it to all the A-rated carriers, good, high-quality carriers, and see what the cheapest amount of coverage that we need. And typically what I like to do is a 30-year policy. Why? Mortgages are typically 30 years, and also your kids, hopefully, they're going to be out of the house by 30 years of age, and so you're not going to have to worry about that. So those liabilities are going to be gone during that period of time. Also, just so that you know, not really about life insurance, but if you are this father who passes away, your spouse and your children can collect a percentage of your Social Security, which in this case, someone making about $100,000 would be about an additional $3,000 on top of that. So what we've done through good and proper planning and buying a 30-year term life insurance policy, we protected the family. Now, can you do that same thing with an index universal life insurance policy? Yes, you can. Of course you can do that. But what I'm going to show you is when you do that, the cost is considerably higher than with the term insurance policy. And so when that happens is what a lot of people do, and what I've seen happen time and time again, is if they're being sold this permanent life insurance policy, what they do is they buy that, but instead of getting the $2 million in coverage they need, they might reduce that to $250,000 or $100,000. And therein lies the problem. They wind up under-insuring themselves. So if you were someone who has a family, you're looking to protect them with life insurance, this is the exercise that you should be doing, is you should say, what are all my liabilities? We talked about this person having a $500,000 mortgage. Maybe you're somebody to make that $100,000 went through school and you've got student loans of $50,000. You might have credit card debt of another $50,000. So you might be somebody who took the $500,000 mortgage plus the student loan at $50,000 plus the credit card debt at $50,000, and you might want to have $600,000 to cover your liabilities and the same 1.5 to get the rest. So you might need a $2.1 million policy. But really, guys, you do not have to be a financial analyst. You definitely don't have to be a life insurance agent. You just have to understand what your expenses are, what your liabilities are, add those things together, and then you're able to determine how much life insurance coverage that you need. So what we're going to do now is break that down for this couple, for this husband. How much is it going to cost to buy the term policy? How much is it going to cost for them to buy the indexed universal life insurance policy? Let's take a look at that. Now what we're going to do is we're going to go out and shop this. And like I said, guys, it really doesn't matter who the carrier is as long as they're an A+ rated carrier. There's tons and tons of good carriers out there. At our firm, we shop it across all of them because here's the thing. It depends on where you live, how good your credit score is, how your health is, depending on your own personal situation, who's going to give you the best deal. But whoever does that, I always tell people, go and find yourself the cheapest policy from the highest quality carrier that you can find. So what I did is I have an insurance agency. So good news for you is I get to tell you exactly how much it costs for this couple. And also good news for you, maybe not so good for some agents out there. I'm going to start telling you how much money these people are going to make from selling you this policy. But let's first get into this. So I ran a 30-year term life insurance policy for a 30-year-old male, non-smoker, in good health. And what I found out is for 30 years, for $2 million, it's going to cost them $151 a month. That's going to give them $2 million in coverage as long as they pay that every month for the next 30 years, no matter what happens to their health, what happens to the market, whatever happens. If they were to pass away during that period of time, the wife is going to get a check for $2 million that is tax-free. That's important to understand from any death benefit of life insurance. It's always going to be tax-free. Now, I also ran the same thing if I needed that $2 million in coverage on a index universal life insurance policy. Remember, I told you, you could solve for the same thing. It's just going to cost you more money. So the question is, when I ran that, and I ran this one through Nationwide, which is a great company, the amount was $1,566 a month. So you could pay $151 a month, or you could pay $1,566 a month. And remember what I said, this is a point in time where people are either sold a bill of goods to where they go ahead and they put that $1,566 into this policy because they believe it's going to give them financial freedom. Or unfortunately, what happens is a lot of people say, oh, I can't afford that. How much would it cost me for $250,000 or $500,000 in life insurance? And what they wind up doing is that. And sadly, a lot of times that $250,000 or $500,000 costs you 2 or 3 times what the term insurance policy does, but you wind up underinsuring. And we already said this family needs $2 million. $250,000 isn't going to do anything. The mom's still going to have to go back to work. They're probably going to lose their house, and that's the problem. So why do people even do this? Rob, why are we even talking about it? We already said it seems like term is a superior product. I could see clearly now it's a lot cheaper. I'd rather pay $151 a month than I would almost $1,600 a month. What's happening? Why are people being sold this? And so what I wanted to do was a few things. Okay, number one, what people want to know is the agent selling them on this $1,500 and $66 a month policy. What are they showing them? What are they showing them in 30 years that they're going to accumulate? How much money are they going to have inside of this policy? Okay, so what I'm going to show you is an illustration. Again, we have an insurance agent. I didn't make this up. We're an insurance agency. We went out, we asked Nationwide for this couple, what would it look like? And illustrations are super ambiguous. They're not transparent. I'll tell you, most of the agents that are out there selling these things don't understand how they work, and 99.9% of consumers buying them have no idea. What I'll tell you is they're usually ran at some type of illustration rate that the insurance company recommends. These are not guaranteed. If you get the guaranteed rate, what it will show you is in 30 years, you absolutely have nothing. Sounds a little confusing, but what they do is they give you a guaranteed rate of return in these policies, which is usually very low because the cost of insurance could go up, interest rates could change, and if it's based only on the guaranteed rate, usually these things blow up. Usually in 30 years, not only do you not have any money, you have to put more money into just keeping these things alive. These are some of the ugly truths that the agents never tell you. But let's play the game. At 4.5%, which is somewhat reasonable, what they're showing you is that you're going to have accumulated after that period of time $1,363,000, and the amount of money that you would have put into it over that 30 years, remember, because you're putting $1,566 a month, you would have put in $563,000, and you'd have a, let's not say not death benefit, but what's called an accumulated value of $1,360,000. Now, the question is, and a lot of people say, hey, Rob, that doesn't sound too bad. I put in just under 600. I've got 1.3 million. I've a little bit more than doubled my money during that period of time. How do I access the cash? And here's the little trick. They try to tell you that it's tax-free cash. Well, first of all, it's only tax-free if you take a loan out of that. If you try to take a check right away for that amount of money, you're going to have to pay taxes on it. Also, if you take too much of that loan out it's going to cause the policy to go into decline and you're going to have to put more money in. And again, people don't understand this who are buying it. The agents don't understand how to explain it to you. So it becomes this black box of maybe I could access this 1.3 million tax-free, but I have to know how to do it. And here's another misconception I want every single person to know. And I've heard agents say this the wrong way. I've heard people who buy these policies talk about it incorrectly. They say, oh, well, but if I die, Rob, at 60, and remember, again, this is a 30-year-old couple, if I die at 60, then my wife's going to get the 1.3 million plus the death benefit, which is tax-free of $2 million. So they actually wind up with 3 plus. Not true. And here's something you need to understand. You never get both. You only get the death benefit. So that cash value of 1.3 million goes away. Your wife, in this case, would get the death benefit of $2 million. You never get both. So I want you to understand that about. And also, this tax-free money that they're telling you about, you can't just take that out, guys. And as a matter of fact, during that first 10 years, you really usually can't take any of it because of surrender charges. Okay, but let's stop there. So we showed you put in this $1,566. You do that for 30 years. You have this money that's accessible of $1.36 million. Okay, but I told you that what we want to do at the beginning is separate the insurance needs, separate the insurance, and then separate the investments. So, okay, you might have heard the term buy term and invest the difference. A lot of people talk about that. So in this case, what they're saying is get that $2 million policy for $151 a month, but let's take the rest of that, the difference between $151 and $1,566, and let's take that $1,415, which we have, and let's invest that in something. Yeah, you can't go and play blackjack with that. You can't spend it on depreciating assets. But if you're going to commit to this index policy for $1,566, you can commit to this other strategy where we buy the term policy for $151 a month and we take the other $1,450 and we invest that. So what are some of the ways that we can invest? What have I recommended for clients? So one of the things I do is I work with a lot of entrepreneurs. And entrepreneurs in particular are very vulnerable during the early stage. So you think about this 30-year-old couple. If he's starting a business, a lot of the money is going back into that business. There's not a lot of money in savings. So that insurance policy is very important. But as that business starts to go, yeah, they start to have some extra cash flow that they can invest. And what I don't want them doing is investing in this index universal life insurance policy. I want them doing several other things. So let's just talk about 3 things that I've recommended in the past, 3 things that I think you can look at. So one of the great things is, in terms of tax-free money, if you're an entrepreneur, or a lot of you probably have it. I know at my company, we offer this to our employees. There is something called a Roth 401k. And so a Roth 401k allows you to put over $20,000 a year into it. Anything that you put into a Roth 401k, when you turn 59 and a half, so remember, we've got a 30-year-old. In 30 years, they're going to be 60. Once they hit that period of time, all the money that they've put into there, all the gains that they've had inside of there, those literally are tax-free. And so if you want just a check at the end of that, so we said in the index universal policy, you had 1.36 million, but you can't just take a check. You got to play their rules, and you got to take a loan out of it and all this other nonsense. In the Roth 401k, you could take that money and do whatever you want. Pay off your house, take vacations, send your grandkids to school, whatever it is you're looking to do, that's your money and you're paying no taxes on it. So this nonsense about life insurance being the only tax-free vehicle out there, about it being a great investment, is not true. I just showed you one way that you could take all of that money and invest it in a Roth 401k. And you think about in the 401k, what can I invest in? Guys, let's keep it simple. The S&P 500, you probably heard of it. 500 of the largest U.S. corporations, they do business in the U.S., they do business overseas, and over every single 10-year period of time, the market has done well. If you look at long periods of time, the market has always averaged about 10% rate of return. So the question is, and pretty much I've never seen a 401k who doesn't have access to a good, cheap S&P fund. If you put that money every single month into a Roth 401k, you put it into the S&P index fund. The question is, I already know I can get 1.3 million in the index universal life policy. If I followed that, Rob, what does that look like? Okay, take a look. After 30 years of contributing to that Roth 401k, it's not 1.3 million that you have tax-free. The amount of money that you have after that period of time is $3.1 million, so more than 2 times that. So again, this is where we start to debunk things. I'm able to take the same amount of money, get the coverage that I need for that period of time, and at the end, I've got 3.1 million that I can walk away from. And also, let's remember, the whole thing they said, well, you don't have insurance coverage anymore. Yeah, true, but you've got almost $2 million more. So you've got, like I said, you don't get to keep the death benefit and the cash value. So you've got 1.1 million more than that death benefit. It's all tax-free. You don't have to pay taxes on that anymore. And let's go back to talking about why do we get insurance in the first place? Because we had liabilities, more liabilities than we had income. But after 30 years, you put away tons of money inside your 401k. You might have built businesses. And oh, by the way, the mortgage is paid off. Remember the 30-year mortgage? Oh, by the way, the 2 and 3-year-olds are now 32 and 33. So they're not dependent on you anymore. And if you got great kids, maybe they're even helping take care of you. So this is why I never recommend the index universal policy, because we have more flexibility. And most importantly, like I told you, it's not an investment. We make an investment in stocks, in bonds, in real estate. So that's just one example of what you could do instead of the index universal life policy. The second thing, well, the S&P 500, pretty good, safe, long-term investment, but there's other investments out there. And now more than ever, these things are becoming available in mutual funds and ETFs where anyone could access them. Take a look at technology stocks over the last 20 years. Last 10 years, they've done about 22% annualized. You could access those through companies like Vanguard. Private equity, investing in private businesses, which most people can do. And if you take a look at a little higher rate of return, yes, higher risk, but when you have that long-term time horizon, it's not really that much risk, then the return can go from 10% to, with a little bit more risk, you have the opportunity to invest now in an asset returning 12%. And when we do just 2% more per year, it's not 1.3, it's not 3.1, but then you have $4.5 million. So you see, again, separating the investment from the insurance allows us to continually build up that net worth. And here is what I've used term life insurance for myself. And I'm somebody who's got an 8-figure net worth. I talk my own book, guys. I own 0 permanent life insurance. I have over $10 million in term life insurance policies. I own 0 temporary. Why did I do that? Why? Because I want all my liquidity, I'm an entrepreneur, to go back into my businesses. And by not paying thousands and thousands of dollars a month to an insurance company, I'm able to free up that money to invest back into my business. So when I work with entrepreneurs, that's what we do. We get the term life insurance to take care of their family. They might have a key person to where they say, hey, my partner, John, God, Rob, if he were to pass away, my business would be in so much trouble. How do we get by until we can find somebody else? Well, we can buy a key man term policy for them so we can bring some money in for the business. We use term policies to solve for those needs to make sure that we can reinvest back into that business, guys. And most entrepreneurs that I work with, the truth is they do more than this. But if we just use a 20% internal rate of return on their business, which most of them are getting, and remember, if we can get 12% investing passively, if you want to take on the risk of building your own business, you better be getting a 20% rate of return. So if we did that and we invested into our own business, and what I'm trying to do is help people build enterprise value, build a business that at some point in time, let's say in 30 years, in this example, that business is worth something that they can then sell. So if we were able to do that inside of a business and get a 20% IRR that we were reinvesting that capital, what does that look like? significantly higher. That number at the end of the 30 years, $24 million. So this whole nonsense, guys, about investing in life insurance, throwing your money away with term insurance, that's the biggest thing I hear time and time again. You're just pissing your money away. You're throwing your money away. That's true if you take that $1,400 and you spend it on worthless crap. But if you're taking that and investing in yourself and your own business, if you're investing in stocks, private equity, obviously you can do real estate, that money is going to grow significantly higher. So look, I think by now you're starting to understand that term life insurance is a pretty good deal. And I'll tell you, as an insurance agency owner, and I'm going to show you right now, there's significantly more money in commissions that are paid for permanent policies. Hint, hint. We're going to get into that next. But if you're thinking about how do you put yourself in a position to accumulate real wealth, please, guys, stop listening to the nonsense of tax-free money. Please stop listening to the nonsense of be your own bank. Please stop listening to the nonsense which we just disproved, that you're only throwing away your money with term life insurance. And now let's get into the reason, though. Why are these things pushed so hard? Why are so many people messaging me after they hear me talking about the pitfalls of these permanent life insurance policies? Some people literally crying of how much money they've wasted in these things. Why are people time and time again buying these things when it's really pretty simple of what I just showed you? How much insurance do you need? How cheaply you can get it, term life insurance? How much optionality it gives you to go out and build a business or invest in things that are way better than handing your money to an insurance company. Let's just think about it, guys. When you give your money to an insurance company, what do you think they do with it? They invest. They buy real estate and they buy stocks and they buy bonds with your money. Why not do that for yourself? I'm telling you that commission income plays a big role in why these things are being sold so hard. And I like to think that I'm the most ethical person in the world. I like to think that people I deal with are the most ethical people in the world. But I understand people have families to feed. And I think this is one of the problems. And I think this is one of the things that a lot of these insurance agencies that are out recruiting young agents, young advisors are leaning on. And so what I wanted to do is just give you guys an idea of a new agent, advisor that's coming into the financial services industry and the range of products, offerings that they can sell somebody when they're trying to do a financial plan, what those look like and how much they're compensated. Because I don't care who you are, money is a huge motivating factor. And I would say in terms of life insurance, it's the number one, and in some cases, unfortunately, it's the only motivating factor of why you see agents selling these policies to people. Okay, going back to our couple, the $2 million policy, they've got $1,566 a month to invest. So yes, that's a lot of money, but when you think about that, this isn't the ultra wealthy. These are a lot of average middle class Americans that are being approached on how should they take that $1,566 and allocate it for their financial future. And I think we already told you, I believe the best thing to do is in a financial plan, get the insurance that you need cheaply and take the rest of that money and invest it. So if I'm one of those agents and I'm looking at how can I do this, what can I take that $1,566 and put it into, and how am I going to get compensated? I think it's important that you take some notes and you understand how that works. One thing, if you came to me and said, hey, Rob, I've got $1,566 a month I can invest. I want to invest this. Where do you think one of the best places to do that is? Well, we already talked about the stock market being a great place and maybe even a diversified portfolio. And so if you go to an asset management firm who specializes in asset management and you put that $1,566 a month away, they're going to invest you in stocks, ETFs. You're going to get a diversified basket of investments. A lot of good people out there that over time you should be earning 10 to 12%, a great cornerstone of any investment. Now, the person giving you that advice to make that investment, how much do you get compensated on that? Typically, it's 1% of the assets. So if you were to put that amount in every single month, the amount they would make that year off of you at 1% is $180. The next thing is, if you go to Chase or Bank of America, a lot of these guys sell products, okay? Not entirely bad, not something that we do or really recommend, but hey, you can buy a mutual fund. And these are typically called loaded mutual funds, which is what they're selling most of the time at banks. The typical commission is somewhere around 5%. So if you go to the bank, they sell you this JP Morgan technology fund or labor whatever it is, and they give 5%. How much did that agent make? He made $940 because it's a 5% commission. Okay. Now, if you look at some of the other things that they have to offer you, at the bank, they might have real estate investment trusts, or these are like mutual funds, but instead of buying companies, they're buying different buildings that are then paying income, and that might be a part of your investment. For some people, for most people, a good part of their portfolio. They have annuities that they're selling to you, which give you a guaranteed stream of income. So you give them a certain dollar amount, and then in the annuity, that's going to pay you back a dollar amount for the rest of your life. Those are two very common investments, and the typical commission on those is 7%. So if that agent sells you an annuity or he sells you a real estate investment trust, same amount of money, guys, $1,560 a month. That year, he's going to get a commission check for $1,300. So you can see we started at $156 and we start getting into more. Now, if you came to me and said, hey, I want to buy the term life insurance policy, that's $1,500 a month. How much am I going to get paid? That term life insurance agent will get a check for $1,600. Now, typically, just so you know, when someone sells you a term policy, it's dependent on the insurance agent, how much his company pays him, but typically the commission on those is somewhere from 70% to 100%, meaning if you pay $1,000 a year on a term policy, that agent will make $700 up to $1,000, and there's nothing after that. There's a lot of guys out there. I think Primerica is one of the companies where they say, buy term, invest the difference. So we will sell you the term life insurance policy, and the rest of the money, I'll put you into one of these mutual funds where I'm going to make 5%. Not a bad strategy. Again, I think for most people, there's things that are better than to do that, like the managed account. But for most people, that might be okay. How much does that agent make? Well, he's making more, and he has to have a license to sell you. It's usually a Series 6, the mutual fund, and he has to have a license to sell you the insurance policy. So if he sells you the insurance policy, he puts the rest of the money into a mutual fund. His check is going to be $2,450. So we started at $156 in commission. That the one guy who said, hey, just invest in stocks, I'll charge you 1%. He made $156. Now we've kind of moved up the food chain to the guy who can do the insurance for you and sell you a mutual fund. This year off of you, he's going to make $2,450. Okay. Now, let's talk about the guy, though, who sells you only the indexed universal life insurance policy. Because remember, this is an investment, and it's insurance, and all this stuff they tell you, and this is what the rich do, and it's tax-free. Be your own bank. And a lot of you are probably listening to this and saying, that's exactly why I did it. They're selling you on all this. And what I'm telling you about indexed universal life insurance policies, every time I've seen someone come into my office, not one time did they go out looking for them. 100% of the time, they were sold them. Term insurance all the time. You can go online and get them yourself. It's the agents who sold them into buying this, who sold them into believing that indexed universal life was better than investing in the stock market. It was better than a Roth IRA. And this is what you needed to do to create financial freedom for yourself. And we already showed you in the previous illustration, and I hope you believe by now that that's nonsense. So how much does that person make? And again, you're going to see the comments in here. They didn't structure the policy right. There's different ways to do it. It's all bullshit. I'm here to tell you, as someone, again, who owns an insurance agency, I could show you what Nationwide said of any of your agents that sell this policy, no matter how we structure it, how much money they're going to get paid. And in this case, exactly the way the policy was. You ready for the commission? And I'm telling you, this could be more. This is an average structured commission that this person made. It's not $156. It's not $2,450. That person gets a check after you sign the contract for $14,960. And if you don't think that is a motivator, let's just think about this again. One guy gets $156. One guy gets 15 grand. The guy who sells 2 of these things a month, just needs to get 2 people, makes $360,000 a year. The guy can get 1 person a week, and there's a lot of these guys out there who get a lot more than 1 person a week. He gets 1 person a week to buy into this strategy. He makes $718,000 that year. How about the guy who told people buy term and invest the difference? Same dollar amount that was invested. Makes a good living, but he makes $117,000 that year. So you got the agent who tried to do the right thing, advisor tried to do the right thing, just makes over 100 grand. And then you got the guy who's out there pitching people that this is better than sliced bread. It's the next coming. That guy makes $718,000. And so you can see, guys, money is a motivator. Whether you believe that or not, this is the American Capitalist Show, guys. We do things, we work, we invest because it's the means to an end. We're trying to support our families. And when you are an agent, and I'm going to talk about who are these people next, a lot of times you don't know any better. Do you want to learn how to sell something that the same amount of dollars, same amount of clients, same amount of effort for you, actually less, because all you need is an insurance license? You make 700 grand a year, or do you want to make 100 grand a year? Let's talk about that. To be an insurance agent only, to be able to sell you this index universal life policy, whole life policy, whatever it is, all you need is an insurance license. Okay. A lot of these people are parading themselves as financial advisors. Look, in the United States, to call yourself a financial advisor, you don't need any education whatsoever. There's no requirements around that. You don't even need a high school diploma. And to obtain an insurance license, I don't have my insurance anymore because I'm not actively working with individual clients. But when I obtained my life insurance policy, I studied for 2 days. Life insurance is not hard. A life insurance license is not hard to get. And by doing that, you're able to go out and sell these things. And so you start thinking about, I already told you, there's a lot of money in these policies. Okay, and how are most of these policies being marketed, distributed? Well, there's big organizations out there that make their money by recruiting people, selling them the allure of financial freedom, not only, and really not about the people that they're working with, but about themselves. Come in here, high school dropout, whatever it is, we'll get you an insurance license, put you through a 1-week course, and you too can make $1 million a year, and they will parade around a bunch of clowns who are out there who are really just good motivational speakers, armed with an insurance license, who are making millions of dollars. And I've even seen inside these organizations where they're out there showing people the paycheck of these people that are out there. That's the truth. And so, a lot of you guys out there are on social media, you've probably heard of Patrick Bet-David and his company that he built, that he sold to Infinity Marketing. And this is not about beating up on Patrick Bet-David. Don't know him personally. What it's about is getting you to understand who are the people behind this, how are people being recruited. These are multi-level marketing companies, and the way they make their money is by recruiting as many advisors, agents, whatever they call themselves, as possible. The problem is, though, in this market, you are the product. And the goal, as I said, is for you to put as much money into these insurance policies as you possibly can. The agent gets some, the company gets some, and we go on and on. And the problem about this is, as someone who owns a financial services firm, they are recruiting thousands and thousands of people with this dream. And I could tell you, for me to just in 1 year find 4 or 5 highly qualified financial advisors, we're able to sit down with our clients and do just what I did at the beginning of this. Create a plan. How much insurance do you really need? What's the cheapest way to find it? Should we use a Roth IRA? All those types of plans. It is very, very difficult to find the right people that I can trust, that are educated enough, that put our clients' best interest at first. And so when I hear about thousands of agents being recruited, and I know a lot of these people, these are people that are being recruited quite honestly, they just want them to be good salespeople. The truth is, the less they know, the better. And I'll tell you a quick story about that. An advisor who used to work for me had a business he built and sold. By the time he was in his 30s, he was a multimillionaire. And a friend told him, hey, I'm making a ton of money selling index universal life insurance policies. And this guy, let's call him John, was a good salesman. He went and got his insurance license, started doing seminars. We were out there recruiting. Remember I said these index policies are sold. His first year, he made $500,000. But John, being the person that he is, said, you know what? I'm getting asked a lot of questions about financial planning, and I don't really feel comfortable selling this. Let me do something. And so what John did is he set out to earn the Certified Financial Planning designation, the highest designation that you can get in financial planning, typically what most of our financial advisors have. And you know what he learned? About halfway through that course, he was robbing people. He realized, like, this is absolutely not what I learned in that seminar. This is absolutely not the right thing to do for clients. And what he did was he stopped doing that. He started doing the right thing by clients. And what he saw in year 2, I would love to tell you he doubled his income, but he saw it cut by 80%. 10 years later, he was making magnitudes of that by doing the right thing. And that's the idea, is when you do the right thing, especially for you agents out there who are watching this, when you do the right thing for people over a long period of time, you're rewarded. It's sustainable. You last. Your reputation takes care of you. You get referrals. But when you burn people, yeah, you might make 700 grand or 800 grand for a year or two, but eventually the chickens come home to roost and that goes away. And so what I want to tell you guys is, if you are out there looking for a financial advisor, look for a fiduciary, look for a certified financial planner, look for someone who has your interests first. If you're someone doing this for yourself, I'm hoping at least by now that you understand that term life insurance for your insurance needs is probably what you should be doing. Also, when you buy a term life insurance policy, one of those things that permanent guys don't want to tell you is you can convert that at any time if you needed it later on down the line at the health rating you came in. So if you bought it at 30, at 45, you realize, hey, I do need some permanent coverage, but I'm not healthy anymore. The insurance company that you bought it from will have to convert you at that same preferred rating. Again, these are the things no one wants to tell you. Those are the things you probably don't understand. But what I'm here to tell you guys, the term life insurance is probably what 99% of you should be thinking about. Once you get to a point, and here I'm going to leave the caveat to say, is permanent insurance always horrible, Rob? Is it something I never should touch? No. If you're at the point where you cannot spend all the money that you have, if your money is definitely going to outlive you, if you're looking to just pass this money on to the next generation, then there are some strategies where it might make sense. But for now, guys, please avoid that. And for those of you guys, we'll wrap this up, who are looking to create wealth, if we know it's not indexed universal life, how do we do it? Well, it's buy term, it's invest the difference. It's do proper planning, asset location. Should I use a Roth IRA? Should I use a SEP IRA? The first place to do is find yourself a fee-only financial advisor who will create a plan for you if you don't know how to do it yourself. That's kind of like finding an architect to build your dream home. You don't have to go and build it right away, but get the plan so that you know what to do. Please avoid these guys, please. And what I'm hoping that this episode does is that it stops somebody from being like my client that I knew, who leaves his children without income, where they have to sell their house, where they're left in a situation where all their hopes and dreams are diminished, and the wife now has the burden of not only losing her husband, but how do I feed my kids? You're going to hear comments and people tell you Rob is wrong, and you can believe that. But Rob has worked with average people when he first started to the wealthiest people in the United States for over 25 years. Rob has been able to do asset management. He's been able to do insurance. All these things, guys, I could get compensated by doing all those things. The reason I'm still here, the reason I'm still standing, the reason I continue to attract the highest net worth clients out there, the reason our firm continues to do what it's doing is because we always put the client's best interest first. And when you do that, agents out there, you will thrive. And for people out there, please, 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 I can tell you, every single time, not 80%, not 90% of the time, that somebody's brought one of these policies in, the dreams they were sold, the illustrations that they were given, I've never seen one of them work out. Instead of ending up with a retirement plan and hopes and dreams, what they get is a lapse notice, meaning if they don't put more money into this policy, that it's going to blow up. They ultimately wind up understanding that they got taken advantage of. And if you were someone in this situation, what do you do next? If you've got a policy already, take a look at it. Find somebody independent to review it for you. Does it make sense to stop paying? Can you surrender it? Most importantly, when you bought this insurance, did you get enough insurance? Did you get the right type of insurance to make sure that your family is protected? If you didn't, please review those things. And most importantly, what this show is about is please continue to educate yourself. Please continue to ask questions. Understand that no matter what you do, money is always going to be a motivating factor. And at the end of the day, when you talk about these permanent life insurance policies and why this has almost created a cult-like following to sell them to you, money is the number one motivating factor. And unfortunately, it's not your money, it's theirs. So don't be a victim, educate yourself. Thanks for watching this episode of The American Capitalist. Please share this with a friend. Please share this with someone who their family is depending on their income. Do not be a dad who does not have a term insurance policy to protect your kids. If you're a mom, single mom, do not be a mom who leaves your kids behind without a cheap term life insurance policy to make sure that they're taken care of.